Hello and welcome to Market Domination. I'm Julie Hyman, Josh Lipton back live from our New York City headquarters. We got 1 hour to go until the market close. So let's take a look at the major averages here. Kind of a muddle to end the week here. Really struggling to maybe eke out some gains and not quite making it there for the Dow, at least not right now. It's down about 80 points, not even 0.2%. The S&P down about a third, 1%. And the NASDAQ also kind of hugging the flat line here. I'm also looking at the weekly numbers here because it does look like we're going to have a rebound on the week, maybe here. At least that's how it's setting up right now. Up 0.9% for the Dow, up very barely for the S&P. So that's going to be more of a photo finish. And the NASDAQ not quite making it.
It's also an interesting trade day, Julie, because it's a trade day full of big names and big names that reported and really have kind of underwhelmed across a wide range of industries. You know, you had Micron, which we watch carefully, largest U.S. maker of memory chips. You know, those chips go into a lot of important end markets. They reported, they disappointed. Look at that, we're down about 8%. You had Nike, a read on the consumer, also reported, investors there also very clearly underwhelmed. You could take a look at Lennar, home builder, again, impressed. And finally, of course, you look at FedEx, considered by some, still an economic bellwether, right? Investors are unimpressed too.
And then I was going to call up FedEx as well. Looking at the Dow transports in particular, and what we're seeing here from FedEx is down by 6%. So you're right, a lot of this having to do with commentary. And one of the common threads between a lot of these is concern about the economy, concern about the consumer, concern about the effect of tariffs. Certainly that was all intertwined with what we heard from FedEx here. And Rick Patterson over at Loop Capital talking about that FedEx, if there is to be a recession, and he says, just to know this, not saying there's going to be, but that this is not a stock you want to own if indeed there is going to be that kind of economic downturn. And
you mentioned tariffs as well. We got more President Trump headlines today too, where he seemed to suggest maybe there would be some flexibility there, perhaps. And of course, we're watching that very carefully because that's all coming ahead of these reciprocal duties we expect early next month.
Yes, exactly. A lot of trepidation ahead of all of that.
Well, markets point to muted action after another volatile week on Wall Street. And our next guest says the economy's soft landing is what's really behind the weakness so far this year. Joining us now is Daniel Morris, BNP Asset Management Chief Market Strategist. And with us for the hour, of course, the one and only Corey Johnson, Epistrophe Capital Chief Market Strategist and host of the Drill Down podcast. Welcome to you both. Dan, start with you here on the markets. And I thought, Dan, your comments are interesting. You're looking at the market action this year, Dan. You say, in your opinion, this has really been much more about the macro. It's about the slowing growth more than the tariffs, Dan. Walk us through that, because I can't tell you that we got a lot of strategists on. Really, the word so far we hear over and over again, focus, the attention has been on tariffs. Why do you say that?
Well, I think that misses the point, and that's important because if you're not analyzing what's really going on in the market currently, I think you then miss what might come next. So think back to what we thought was going to be the outlook for 2025 before the election, and the word we kept repeating over and over, of course, was soft landing. So that meant growth was supposed to slow. Inflation then would come back down towards target, and then the Fed cuts rates, and we were going to all be quite happy. Now, we perhaps got a bit distracted by what happened subsequently with the election. Of course, the market started pricing in what it anticipated as pro-growth policies from Trump. But we got to remember there's a sequencing effect here. If that happens, it's not going to be right away. You need time for these things to filter through for the economy. The economy is going to continue doing essentially what it was going to do. And I think it's that soft landing that we anticipated. So from that point of view, we shouldn't be surprised. That's what we thought was going to happen. And I think fundamentally, that's the key thing that's behind the market. Of course, tariffs come on top of that. But the key point, I think, is the soft landing.
But it is a softer landing than anticipated by many. I mean, you're looking at GDP forecasts that a lot of places are revising lower, and many are attributing that to the sort of survey data that we've gotten, the weakening sort of confidence in part.
Yeah, I guess I, again, kind of question the analysis that's going on there. So if we go back to the growth rate we had at the end of the last year, 2.8% if you look at core GDP. Well above trend. We expected that to go down, right? That's all part of that picture, towards 2-ish, let's say. So we're kind of going in that direction anyway. I think some of the numbers that you see in the calculations of the GDP now are a function of the surge in imports you had ahead of the tariff. So that does have a mathematical impact on the GDP calculation. But if a lot of those imports just end up in inventories, you'll more or less see an offset in the GDP calculation when the figures come out. So I still think we're looking at a 2 handle for GDP for the first quarter. We'll see. Not an economist, no predictions on what's going to come out.
But if we get more layoffs at the Fed, right? We see consumer confidence concerns spiking. We see concerns about potential inflation spiking. When just that concern alone pulls back, see the consumers spend less.
Conceivably, I mean, you always talk about the feedback loop. I just want to highlight one thing on the decrease in consumer sentiment, because if, to the degree that we went back to Trump 1 to say, okay, there's my playbook, everything is going to go the same. And one thing you certainly saw during the first Trump administration was both consumer confidence and business confidence both shot up. And both of those back then stayed quite high. What's been different this time is that business confidence has actually, despite tariffs, right, still quite high, but you've seen this drop in consumer confidence. And then if you just read the headlines, it's, oh, well, tariffs are dampening consumer confidence and so on. I kind of question that assumption, because what you've also seen, and I would argue more importantly, over the last 4 months, is an increase in headline inflation on a monthly basis. So people are saying when they go into the stores, gosh, prices are going up again. That made me really unhappy last year, and it's making me unhappy again. So I think that's, again, a key driver.
Dan, with all these cross currents, I'm just curious, have you made any kind of meaningful changes to your earnings outlook this year, or held steady there?
Well, I think we pulled back because of this. If you had that initial assumption of, hey, gangbusters, everything's going to be great, we were overweight U.S. equities, honestly, I think like most people. But when we started to have some doubts about that outlook, we pulled back. We're kind of hugging, neutral around now. We're in a transition period, which we appreciate. We're not quite sure what we're transitioning to be honest. So we want to wait, try to have a bit more clarity before reallocating. So neutral now, but anticipating to move back into equities at some point.
And Dan, as somebody who is based outside of the U.S., you're based in London, I'm especially curious to get your take on this emerging piling into European stocks, for example. I saw a chart today that Bloomberg's Joe Weisenthal put out where he looked at the ratio of U.S. stocks to the rest of the world using a couple of ETFs, and effectively U.S. stocks have just dominated. They have been the place to be for so long now, and now we've got this little bit of a blip down in that ratio. Do you think there's some staying power here, or do you think that, the U.S. as the place to be is going to reassert itself?
Well, you see that if you just think about your benchmark allocations, take the MSCI World Index or All Country World, the U.S. is 65 to 75% of that index. And, you think about the other opportunities that are out there in the world. We've seen that now in Europe. We've seen that now also in China. So I think it's probably a healthy reallocation, because even if, in retrospect, honestly, I think the overweight that, again, most of us had immediately after the election was the right one, so to speak, or it made sense at the time. I think the healthy aspect of the markets today is, even if you might still think U.S. equities are going to outperform over the long run, you probably feel a bit better about the outlook for Europe, about the outlook for Japan, about the outlook for Europe, for China. So I think a bit more of a balanced perspective, and therefore, you should probably have a bit more of a balanced asset allocation.
Is it what the moves we're seeing right now about U.S. investors looking to Europe, or is it about Europeans keeping their money in Europe and saying maybe less U.S.?
Well, I'm not sure exactly on the data, but it would ideally be a bit of both. Now, of course, any country has home bias, and given the size of the U.S. market, you kind of wonder how many people really are going to be willing to look abroad. But again, from an asset allocation diversification point of view, probably a healthy thing.
Your expectations, Dan, for the Fed this year, what are you telling clients?
Well, this is interesting. If you look at Fed forecast for Fed funds at the end of this year, so we're now back down about around 350 the last time I checked. As it happens, that's more or less exactly where we were before the election, when we thought we were going to have a soft landing. So you had the big sell-off in expectations, thinking it was going to be more growth sooner. We're now kind of back to where we started. So I think that those two cuts or so, 350 or so, reflects, again, what I think is that soft landing outlook. No longer that risk of overheating that we had initially, but also very much not a recessionary forecast. So, if the data continues to come in line with that expectation, then it seems reasonable to me.
Dan, thanks for coming in.
Thank you.
It's good to see you in person.
Likewise.
All right, we want to bring you an update on the situation at London's Heathrow Airport. The first plane landing there a short time ago. The airport was closed for most of the day due to a power outage that delayed travel for hundreds of thousands of passengers. That outage caused by a fire at an electrical substation supplying the airport. About 120 aircraft were en route to Heathrow when the fire broke out. And the airport says it expects significant disruption for days.
A much-needed win for Boeing. The stock surging after securing a major contract from the U.S. government. We've got the details. That is straight ahead. Boeing getting a boost as it lands the contract to build the Air Force's future fighter jet. The aircraft manufacturer beating out rival Lockheed Martin. This government contract giving Boeing a much-needed win here. And joining us now is Gabelli Funds portfolio manager Tony Bancroft. Tony, it is great to see you. And I think, Tony, you're just about the most perfect guy we could get for this segment, because not only, Tony, you, of course, a respected financial analyst, you're also a Marine Corps fighter pilot. So you're about the perfect guest, Tony, for my next question, which is explain to us why this is a big deal for Boeing, Tony, because certainly investors, just looking at the stock here, they're excited by this news.
Yeah, no, it's great to be back. I think Boeing's had a long run with their defense business, and I think the Department of Defense needs essentially a third OEM for their fighter business or potential fighter business. And Boeing has struggled with some of these contracts that they've taken on, and having a large program like this, up to $300 billion lifetime value, potentially, maybe more, depending upon if we get any kind of FMS sales, which I guess that's a question. It's going to be a big deal for Boeing. And now I know there's always buyer's remorse with having to perform on that contract, and I think we saw some of that with Lockheed with the F-35. But all things being equal, this is a big win for Boeing.
Well, is that a question, though? Getting the contract is one thing. Actually delivering on the contract is another. And given all that Boeing is dealing with right now, is it up to that task?
Yeah, I think, listen, Boeing's got a great track record, with the F-18, the F-15, multiple fighter aircraft that they've built in the past. And, they're one of the largest defense contractors in the world. And I think, they've invested quite a bit already. They've invested up almost $2 billion in an advanced facility in St. Louis where they built the F-15 and F-18. And they've got a lot of history doing it. They know how to do it. They have know-how. And I think all things being equal, they'll do very well with this contract. And I think they'll negotiate it properly and appropriately. I think CEO Wertberg has probably learned the lessons of the past and probably won't make those mistakes again of how to negotiate this contract.
It seems that the thing they really need is more 737s. I mean, it's probably about 50 to 60% of free cash flow comes from selling the 737. Is that the number we should be watching here, or should we be watching contract wins?
Yeah, no, I agree. I think, of course, the 737, the production rates in the commercial business is by and large the what's going to drive Boeing's free cash flow and growth over the years and in margin improvement. But the defense business, getting back to what they were doing, sort of pre-COVID, pre all of these, these fixed price development programs that sort of got them in a bind. I think that that's going to help. It's a good business. It's long contracts, a lot of servicing, aftermarket with good margins, and as these contracts come online and sort of develop and become sort of fully implemented, we'll see performance there, and that's what Boeing needs. But no question, the 737 is the grill in the room, and that's got to get fixed. And I think it is. It sounds like CFO West spoke just recently, and you heard some good news out of them on the commercial side. So I think we'll see some good things coming going forward here.
This new fighter jet, though, Tony, I'm just curious, how much money do we think Boeing stands to make here over time?
Yeah, there's a lot of number crunching here and sort of extrapolating, but all things being equal, they build 200 to 300 of them. They're going to cost probably multiple hundreds of millions a pop, and then just all the servicing of them. So the lifetime value, as I said, it can be probably in the hundreds of billions, and then it just depends on how many we buy, and if we do allow this to be exported, it potentially could be a pretty big number long term.
And Tony, to take a step back, what about the sort of reexamination of how the U.S. conducts its military conflicts. In other words, I mean, someone like Elon Musk, who has said, we don't need manned fighters anymore. We should just be doing something like drone warfare. And we've seen the DoD move to some degree in that direction, but certainly not entirely in that direction. Do you think there is that transition going on where we will see more unmanned kinds of aircraft?
Yeah, there's no question. Elon's obviously the smartest guy, if not one of the smartest guys, if not the smartest guy in the room. He's a futurist. He sees how things will be, and there's no question that unmanned autonomy is going to be the future of warfare. I don't think anyone disagrees, but I think where we're at now, there's still time to go, and on top of that, there's also the issue of hacking, of jamming, and that's still a real threat. We're seeing that right now in Ukraine, and it's really changed warfare over there and how they're operating. And I think everything people are aware of that, and I think after watching what happened with Israel's strike on the Iranian air defenses, essentially taking out a fully modern, a large military's air defense capability in one night without essentially being seen, it just shows that the F-35 is obviously very relevant, and it's going to be it's going to be in our arsenal for a very long time. And as such, the NGAD program, this F-47, I think is going to be doing similar things, obviously more in air security, but probably will be able to handle similar situations like that going forward, along with the collaborative combat aircraft and other sensors and features that it has.
Do you worry about steel prices and what that means for Boeing with rising steel prices, rising aluminum prices, tariffs threatening to go even higher for this company? Does it even make them want to change their outlook because they might just want to wait until the tariffs go away, which is what some people might believe would happen?
Yeah, so with regards to aluminum prices, obviously there have been a lot of sort of white papers, research put out about the aerospace and defense industry. Actually, all things being equal, we get most of our aluminum domestically, and anything that we do import would be relatively small increase. I think less than 1% would be increase the cost of a 737, let's say. And the reality is going forward, more aircraft are going to be more composite. So you're going to probably have less reliance on aluminum. In regards to just tariffs in general, and then sort of what the reaction to a tariff from a country that wants to purchase our 737s, our aircraft, that's a different story. But the end game is China, and countries like China, they need these planes to grow. And if you say, hey, we're just not going to buy American aircraft, well, you're going to have to get in line for Airbus. I mean, obviously they have a decade of backlog there, and to get in line would be definitely a few years. And they do have obviously the COMAC 919, but that's going to take a long time to increase production at any rates that are similar to what Boeing, what the two OEMs are doing right now.
Tony, good to see you as always. As Josh said, perfect person to talk to us about this. Appreciate it.
Great seeing you.
Thanks. Well, tech growth concerns, along with policy and economic uncertainty, sending investors exiting out of tech names. Even the biggest tech players have struggled this year, but changes in government tech spending and Doge might unlock a windfall for certain tech companies. We've got Epistrophy's chief market strategist, Corey Johnson, here to talk more about this. You were just in D.C., which is obviously a really interesting time to be in D.C. We were just talking about the contract that Boeing has gotten, but obviously there's a lot of cuts and a lot of re-examination of how DC does things. So what did you learn?
So it was weird because I was meeting all these Silicon Valley executives in Washington, D.C., where we all gathered for, there were two conferences going on. Andreessen Horowitz was having a big conference, and then Elastic had their sort of annual look at the government business in D.C. And the theme that I got that I was really struck by was that Doge is creating chaos, right? And the tariffs on again, off again is creating chaos, and it's making decision planning very difficult for all kinds of companies, and it's making it very difficult to see customers do well if you're a tech company selling something. But Elastic's CEO Ash Kulkarni told me that they actually think that there's more opportunities now because incumbent players are getting a second look when they didn't used to. If you're a Booz Allen, you're an IBM, and you're doing billions of dollars worth of business, or even tens of millions of dollars of business with some part of the Defense Department or the Commerce Department, the IT people within these organizations are being forced to look at the stuff that they're doing, and there might be opportunities for other companies out there.
I would ask if is there even a bias against some of those big entrenched
Existing
government contractors to look at more of the Silicon Valley native or tech native kinds of companies?
I have to say that whenever I talk to government buyers, people in government in technology, they're really savvy. They really know their stuff. They sound like people in the private sector. And I sat down with the chief data officer of the state of Maryland, and she was talking about user experience and gathering data together and using it smartly on the cloud and hot storage and cold storage for certain types of data and how to measure. It was like talking to someone in Silicon Valley. I mean, they're really on top of it. And so I think that the notion that there's some paper pusher sitting with his feet in a desk and filling out forms and a clipboard is probably not what's really going on in government. And I think that that's one of the reasons that there's in some quarters been a celebration of Elon Musk and his merry crew storming through the government and firing paper pushers and people leaning on brooms and not doing anything. But I think what we're starting to see is that there's actually people that actually do really hard work to help the world.
But does Doge realize that, I guess is the question. Sorry, Josh. Well, do they realize that?
Well, we just heard from the last guest he's the smartest guy in the room. It must be true.
Who stands to benefit potentially the most from this? I mean, what are the kinds of tech companies, the kinds of tech firms?
I mean, I think it depends on where you're looking in the government. I think that you're going to see cutting-edge software is going to do really well in the government right now. I think you're going to see big consulting firms like IBM, like Booz Allen, and others. I think those contracts are going to get second looks.
All right, we are going to talk about some trending tickers now.
Let's.
So hang on. So it is time for some of today's trending tickers. Let's start with Tesla, which is always trending. The beaten up stock is moving higher today, though, after CEO Elon Musk held an impromptu company all hands on Thursday night, giving an update on the progress of a number of products. He also attempted to quiet whispers that he is ignoring his duties. He told his employees to hang on to shares. He said that robots, the Optimus, are going into production. So everything's okay now, right?
Yeah, sure. They're going to meet all their deadlines now, and he's paying full attention for 5 minutes at this company.
I mean, we already know he was back in D.C. this morning having a briefing at the Defense Department, right?
I wonder if the people at SpaceX are upset.
That they didn't get also a town hall?
Or what about our friend Siobhan Zillis who runs Neuralink and just had another baby or two? Or a dozen kids now. He's pulled in a lot of different
14?
directions. Yeah, it's
something like that.
That point
Well,
is
there are some bulls that have they've urged him to sort of pull back on his involvement in Trump 2.0, but it doesn't sound like that's where his head's at. He's very involved and clearly very excited to be part of this administration.
So I'll be very curious to see what happens when it comes to the government money that goes into Tesla. 33% of free cash flow last quarter was government dole-outs, the exact kind of thing that they're railing about in Washington, D.C. And we'll see how those survive. What we know from the first time with President Trump is people are in until they're not, and when they're out, they're very out. And so you wonder what happens to those government contracts when the day comes that Elon Musk is no longer in.
Mm-hmm.
I have been we've been covering pretty regularly the sell-side analysts who have been cutting price targets. That said, the average price target on this thing is still $345, which is $100 above where it is right now. There was also some reporting that every time the stock goes down, retail investors step in and buy.
But the company's different now than it was a month ago. Tesla was a great brand a month ago. Certainly a year ago it was a great brand. Whether the cars were good, that's a different discussion. But it was a great brand. It is a damaged brand right now because of what's gone on in the White House and the people's view of the richest man in the world running around celebrating firing people with chainsaws and getting rid of benefits for people and getting rid of air traffic controllers at the same time as cutting aid to the poorest people in the world. That's not a good look for any company.
Yeah, well, we'll see if he can repair that damage at some point, if he even tries.
Our next trending ticker, let's look at this one. Micron, those shares are falling today after the company reported that margins will miss analyst estimates this quarter, and that was the reason for this pressure. So they report that margins are going to miss. They forecast for current period core about 36.5%. It looks like it did fall short. Executives did talk about this. Has been a challenging industry environment, called out NAND flash memory products specifically. They did emphasize, they said as the industry environment improves, particularly in NAND, we're going to see a much better trajectory here. So trying to sound a positive tone, but investors were disappointed.
The high bandwidth memory business has been really great for them, and they are really dominant there. And I think that that's going to be the most important business for them going forward. If you look at the products coming out of all the semiconductor manufacturers, you see the big giant GPUs that Jensen is holding up at the conference earlier this week, at the beginning of this week, what a long week. And you see all those little nodes around it, all those little high bandwidth memory things that are necessary for these chips. And I think that's going to be a great business for them going forward. Margins are really about execution. Margins aren't about end demand here. And I think the high bandwidth memory for Micron is going to be actually really great over the next year or so.
And it did seem like a lot of the analyst commentary, we talked to Angelo Zeno in the wake of the numbers last night, among them, who said, they didn't seem that discouraged by the
I didn't think they were that bad.
Right. So
and the guidance was decent.
And it's also the stock has risen this year, which is less and less.
Let me ask you,
I
I bet that there may be some viewers wondering, though, with all the excitement about AI for sure, but if I'm worried of an economy slowing, or maybe something worse than slowing, do I still want exposure to chips that go into smartphones and PCs? How do you think about that dynamic?
So I think I've been thinking about this quite a bit. And the AI spend, everything we hear is AI spend is completely undaunted by other factors right now. And that the few companies that are building out big AI data centers and other companies that are starting to sell agentic AI products like Workday and others really see the spending continuing here, regardless of what happens in the overall environment. Now, market participants might want to think about compression of multiples across the board. If AI spend continues to grow like gangbusters, but PE ratios come down, stock prices go down. But I think the business is going to be really strong.
All right, let's get to another trending ticker here, and that is Lennar. That stock moving lower after the home builder said buyers needed more sales incentives than usual in the first quarter. That put a dent in the company's margins. Lennar delivered a first quarter beat on both earnings and revenue here, but again, it cost them. And this has been sort of the ongoing situation here. The company's gross margin guide for the second quarter was 18%, which is a drop from the first quarter. And, just that when you have mortgage rates are coming down, but not coming down that much, it still feels like that they're having to buy some buyers here.
Yeah, Citi, which has a neutral on this one, cited as saying gross Q2 margin guidance points to a tough spring season. They talked about how management continues to use incentives to bridge affordability concerns. Company also saying, this was interesting, they talked about reflecting continued weakness in the market, or average sales price net of incentives declined to $408,000. That was 1% lower than last year. Stock now down about 30% over the past 12 months.
Well, sticking with the housing market, we're parsing through a lot of the data from the week. Joining us now to unpack everything is Yahoo Finance senior reporter Danny Romero to put all of that housing stuff together for us. Hey, Danny.
Julie, the housing market kicked off 2025 with some momentum as buyers and sellers come to terms with elevated mortgage rates, helping to free up some of the inventory out there. This week, we got a slew of housing data that gave us more color on the current landscape. So let's start with the new home market. We got government data released Tuesday that shows housing starts bounced back in February, jumping more than 11%. And this blew past economists' expectations. And the surge really was led by single-family housing construction, which rose more than 11%. This was the fastest pace in a year. Now, remember, builders have been sweetening up the deal with mortgage rate buydowns and price cuts, driving some activity. However, home builders are feeling less confident about the housing market. The National Association of Home Builders reported that builder sentiment fell to the lowest level since August, revealing concerns about the future demand. And this comes as mortgage rates have ticked up for the second consecutive week. Data from Freddie Mac shows that the 30-year fixed interest rate increased by 2 basis points to 6.67%. The good news here is that mortgage rates are still lower than they were March of last year. And existing home sales also saw a positive surprise in February. According to the National Association of Realtors, Sales increased 4.2% in February. This beat economists' expectations. So looking ahead, with the Federal Reserve's decision to leave its benchmark interest rates unchanged, economists expect mortgage rates will likely remain in their current levels as this spring buying and selling season gets underway. Julie?
Danny, I'll take it. Thank you so much. Appreciate it. Coming up, more market domination. That's right on the other side. All right, let's get to some calls today here. JPMorgan, they upgrade Supermicro computer from underweight to neutral. So not bullish, but less bearish. They talk about uncertainty about pending SEC filings maybe behind us here, Julie. Here they say the company is on the cusp, here's the dramatic part, of benefiting from the ramp in Blackwell-based server shipments, which are already seeing materially higher demand than the prior generation.
I seem to recall, Corey Johnson, do you own this stock?
No,
No, you don't like this one.
I don't give stock advice, but I do not own
But I remember us talking to you about this one.
Not just
for
no,
sure.
God no.
Well, I don't like to own stocks where the CEO and the company have been involved in serial restatements, delisting, I'll call it a bogus investigation. Their investigation of their accounting problems. The committee was a one-person committee who was on the board of directors, who came back and said, nothing to see here, we're going to hire some more people later.
Well, it's enough for the analysts at JPMorgan. They think
the analysts at JPMorgan,
okay,
good luck to you. That's great.
Well, okay, so let's talk about what they do, which is to provide, when you were talking about Jensen Huang holding up the GPU.
They build the stuff that goes in data centers.
Yeah, exactly.
At Supermicro.
So there is, in theory, demand for these kinds of things.
The question is, is a corporate customer going to go to Supermicro, or are they going to go to HPE, or are they going to go to Dell? And what we've seen from HPE and Dell is that their business has not. I really expected that both those businesses start picking up share because I was hearing things like that in the market, and you didn't see that from Dell or really from HPE.
You mean Corey? You expected as Supermicro's kind of pain would be their gain,
right?
Yeah,
and that has yet to materialize.
Yeah.
But there have also been concerns, and Hindenburg brought this out in their great report about Supermicro, that there are concerns about the quality of the products of Supermicro, and that there have been returns. There's online forums where you can see people talking about problems with some of their equipment. Now there's problems with all kinds of equipment out there, but I think it's certainly something. And this JPMorgan note was not a go out and buy the stock. I mean,
it was,
upgraded to a neutral means it started in the basement.
Yeah.
Right.
Do you look, by the way, at that competitive landscape like Dell, HPE? Do you see one of those two having certain competitive advantages in that market?
No, I'm super impressed with what's happening at HPE. I mean, Antonio Neri's just such a fantastic job with a business that has been so bad for so long. I'm constantly amazed when I'm on that conference call or when I'm updating my model. I'm like, these numbers are pretty good. I never said that about HPE or HP. Going back to the pre-Carly Fiorina days.
Oh gosh.
Yes.
Way back.
Again, the demand for what's happening in data centers right now, the spending, the numbers coming out are just jaw-dropping. I mean, the $100 billion Stargate discussion that was suddenly $500 billion.
Right.
But the giant numbers from, and I can't rattle them off the top of my head, but call it between $50 and $70 billion from Amazon, Meta, Microsoft. The spending is going to be just so huge. There's a lot of work out there for all these companies.
Yeah.
Johnson & Johnson, meanwhile, let's move on to that name. They said they're going to invest more than $55 billion in the U.S. over the next 4 years.
Different Johnson.
Donald Trump wields the threat of tariffs in a bid to push companies to manufacture their products in the country. And joining us now to talk about all this is Chris Meekins, Raymond James Managing Director, Washington Health Policy Research Analyst. Chris, it is good to see you as always. Let's start there with that headline. So J&J, they're going to invest $55 billion in the U.S. for the next 4 years, Chris. They're going to construct 4 manufacturing sites. That would certainly, Chris, seem to dovetail with President Trump's broader policy aims. But I'm curious, what would you make of that news?
Yeah, I mean, that's what J&J, the reason they made the announcement, right, was they want the Trump administration to believe that they are aligning with the positions and hopes that the administration doesn't do some of the other things on drug pricing that they would be less appreciative of. So this, to put it in perspective, is a big number. $55 billion is not inconsequential, but it is only about 25% different than what we saw over the last 4 years. So it's an increase, but not a gargantuan increase when you look at global supply issues, and you look at a lot of the other dynamics going on globally at this point. So I think it's notable. I think it's worth watching what they've done, as well as other companies have also tried to highlight their investments domestically. But it's not a dramatically new or a dramatic increase in spending, comparatively speaking, especially when you consider what inflation's done on construction costs over the last 4 years.
Well, and to that point also, Chris, if they are, and we've been talking about so many companies that are talking about or are actually bringing some manufacturing to the United States, what effect is that then going to have on drug pricing that would be manufactured at some of these plants? I mean, construction costs are higher, yes. Labor costs are higher, yes, and probably higher than in other markets. So does that mean this is going to mean drug prices are going to be higher?
I think that is a very smart question. I think that obviously the reasons these companies produce so much overseas is because they can do it more economically. It's cheaper to do so. I think that inevitably some of these cost increases from producing domestically, both their products, but also maybe more importantly, the active pharmaceutical ingredients, so the inputs for those products, is going to be passed along. And the question is, who's going to end up having to pay for that at the end? Will the Trump administration pursue other policy actions that could put pressure on drug pricing? And the pharmaceutical companies have to eat that in margin, or will they be able to pass that through to whether it's the employer market or to government programs?
Chris, when Johnson & Johnson builds factories like this, is it really focused on certain kinds of drugs, or is it just kind of a white box that they can put anything through? I mean, because they do have some important drugs coming off patent. Stellaris is one that is probably $10 billion in sales annually. And I wonder how much the production of these things is so very different when you go from drug to drug, and if these the long-term planning for factories like this are always going to be needed.
Yeah, when I was at the Department of Health and Human Services, we were in charge of helping prepare for and respond to pandemics. This was before COVID, but we made investments in manufacturing and trying to have facilities that could really move from one product to the next. It is difficult to find a facility and structure it in a way that it has broad use among product types. Vaccines and sterile injectables are very different than small molecule when it comes to production and what you have to do. And even turning over lines to new products that are in the same drug class can be challenging with the FDA approvals you need and FDA inspections that are required for these facilities. So it's not easy to create these new facilities. So I do believe they're going to have specific product classes in mind with the 4 facilities that they're discussing here.
Chris, I want to also ask you about some of the spending changes that are happening from this administration. There was a report in the Wall Street Journal that the administration was talking about cutting domestic HIV prevention. There's been cuts to research spending as well. How are you thinking about that and how that's affecting the industry?
Yeah, so it depends on which area we're talking about, right? So if you look at the NIH grants, they tended to be more soft science focused, not the hard science that goes to developing products to help find cures, the cuts we've seen so far, as well as proposals for cuts to overhead at research institutions. When it comes to the HIV products we're talking about a CDC program that produces grants to local facilities to help prevent and really identify people that have this disease and help them get on treatment eventually at the end. So we're not initially talking about the program called the Ryan White program, which really does drug assistance, $1 billion a year for that, treatments for individuals. You're really talking about trying to do prevention, and the very specific pilot program we're talking about was only about, I think, $7 million that was proposed per year, which isn't consequential. Someone who worked closely with CDC and HHS is someone who has a lot of relationships in the public health and local public health departments. I will tell you that overall, there are a lot of hands that take these dollars before they get to actual individuals that need them. And so I don't anticipate at least the initial proposed cuts that we're talking about to be consequential for companies that produce these products.
Well, I guess the question is, will they become more so, Chris, right? Do you expect an expansion of those cuts? Is that Ryan White program in danger, for example?
I think in this environment, everything's on the table. I think with Doge, what you're seeing is them targeting a wide range of products, a wide range of programs. I think you can make an argument that there are other entities that could cover at least some of what Ryan White pays for, whether it's Medicaid or other commercial plans. So it could be a target. And if this is targeted, then obviously that could be consequential as companies try to figure out what the reimbursement will be and make sure all of those who currently receive those products are able to get the treatment they need. The great news is that with advancements we've seen in the pharmaceutical industry, if you're diagnosed with AIDS, you can now have an expected life expectancy of almost the same as someone who doesn't have HIV, which is really remarkable advancement we've seen over the last 40 years and a testament to innovation here in the country.
Chris, good to see you. Thanks for joining us.
Thank you.
We got more market domination straight ahead. Breaking news, StubHub filing for its initial public offering. The company looking to list on the New York Stock Exchange under the ticker STUB, S-T-U-B here. And just looking at some of the details that have come out of the filing here, the company not making money here. In 2024, it lost 91 cents a share, but that was a much smaller loss than a year earlier. 2024 revenue was $1.77 billion. That compares with $1.37 billion the prior year here. But, you know, we had Klarna talking about an IPO. We've had CoreWeave talking about an IPO. So,
well, we did have some well-known venture investors on the show at the start of the year, and some of them were very optimistic about 2025 and you know, this improved conditions. And yes, in part, I think it was a political argument, you know, who was back in charge in the White House. I thought, well, this is going to mean better conditions, gates are going to open, but it hasn't really yet. I mean, there hasn't been the flood. And then you throw in the market volatility we've seen, and you wonder how that'll affect the flood going forward. Going to be a flood or more of a trickle?
Yeah, and we talked to Kelly Rodriguez from Forge Capital yesterday, and he said CoreWeave is really going to be a key one here to see if things are really opening back up or if it's just kind of fits and starts. So
we shall see.
Yes.
All right, Tesla CEO. Meanwhile, Elon Musk holding that all-hands meeting on X last night. Musk hoping to reassure investors after what's been a tumultuous start to the year for Tesla.
So it's very difficult for people in the stock market, especially those that look in the rearview mirror, which is most people, to imagine a future where suddenly a 10 million vehicle fleet has 5 to 10 times the usefulness. So what I'm saying is hang on to your stock.
All right, for more now, we're bringing in Dan Ives, Managing Director and Global Head of Technology Research at Wedbush Securities. Dan, it is always good to see you. So Musk does have this all-hands meeting. You tell your clients, Dan, in this new note, you say this was Musk taking a big step forward with this meeting. How come, Dan? Why do you think of this as a big step forward?
Yeah, and John, we talked about yesterday, obviously in the morning, it was time for him to step up. In other words, you got leaders lead. And during this period, he needs to lead as CEO of Tesla. And I think that's been part of the frustration. But I thought last night was a huge step forward in terms of this quickly put together all hands meeting, because it's showing employees, shareholders, what's the vision, medium and long term. That continues to really be the golden goose. And I think it was an important first step into ultimately more of a balancing act for Musk.
I don't know, Dan. And then he got right back on a plane and went back to D.C. I don't know why him talking in front of his employees is such an important step. And I mean, is it going to keep people from not buying Teslas?
Yeah, Julie, my view is it's a first step. In other words, the whole goal here is, I'm not saying, and the many shareholders, for him to end Doge. It's about a balancing act.
So what else now? So what if that's the first step? What are the other steps? What now needs to happen?
Is that he needs to be more engaged with Tesla. He ultimately even when it comes to Doge, whether it's very similar to how Linda stepped in terms of at X, it's making sure that he is not front and center 5 times an hour when it comes to Doge. I think that, you talk about the political firestorm and everything else, the lightning rod. I think part of navigating that, it's that balancing act. He's going to get criticism, okay? And we understand that. That doesn't necessarily change the brand itself. If he starts to take a step back, that's where I think there's brand damage. It's a scar. It's a bad bruise, but it's not a permanent black eye.
Dan, it's Corey Johnson here.
Hey, Corey.
Last quarter, 33% of free cash flow was from government subsidies, zero emission credits for most of it. 4 quarters ago, it was 100% of free cash flow. Do you start to look forward to a federal government that's cutting unnecessary spending, that has given hundreds of millions of dollars to Tesla, not doing that anymore? Does that change your models in the future?
Look, they've become much less reliant, right, when it comes to the credits. But look, you obviously raise a great point, which has been there, is that, and it's our view that Tesla, 90% of the value going forward is autonomous and robotics, which has nothing to do with EV tax credits. And I think, Musk talked about that in the all hands meeting. That's the future. And my view with Tesla continues to be, 6 times? We've seen the stock sell off 50% peak to trough. The point is we've been through many, very tough white knuckle times before. This is obviously one that's even broader in terms of the political landscape. Doesn't change my view. This and NVIDIA, the 2 best disruptive technology plays next decade.
Dan, let me ask you a different question, which some of your colleagues on the street, it's interesting. They'll say that all this talk of the branding and the politics and the chainsaw and the Mar-a-Lago, that is not really the issue. I've heard some of your colleagues say the issue is much more fundamental. It is a Model Y switchover. It's a Model Y changeover. That is what's meaningfully impacting deliveries. There's too much, they say, being placed on the whole branding debate. What is your take on that?
Yeah, look, I think there's some truth to both. Look, in terms of the actual numbers, in terms of the sales numbers, the brand issues have actually been, called 10 to 15% of the actual decline, because a lot of that is changeover, refresh, and everything else. But Josh, I think in terms of the stock, 70% of the sell-off is brand issue, brand worries, in terms of some of the sort of crisis that we're seeing. And the reason is, it's investors kind of looking forward. In other words, Musk is Tesla, Tesla is Musk. He is the brand. And what he's created is a company that's obviously, globally, in my opinion, one of the best brands in the world. It's making sure that the brand damage doesn't spiral into something much more negative. And I think that's how I'd almost characterize those 2 issues.
I have to wonder if it's already there, Dan. And I also, I've been trying to think of other brand situations like this, right? You think about the Budweiser situation, you think about Target, you think about some of the other recent examples, and it has taken a long time in those cases, and in some cases they haven't even fully recovered, right? So how long, especially since he doesn't actually seem to be trying to do anything to repair this damage in terms of the brand and the image, how long could we see the situation play out?
Look, there's different ways to view it. Some could argue, and we got to see how it plays out, do more Republican or Trump supporters ultimately then start to buy Teslas, right? In other words, ones that weren't buying it, now they're Musk supporters, and that actually becomes a positive. Then it comes down to, when you look at the brand, I think Tesla's brand, it's almost hard to compare, because you're going to have 10 million Teslas essentially on the road going into next year. And when it comes to autonomous, the question is, when you start to actually have cyber cabs, and we have what I believe 1 of every 5 cars autonomous, do people not take that because it's Musk, because maybe something that happened a few years ago? I'm fast forwarding to the next 1, 2, 3 years. So I'm just saying, I get the brand issues. We've talked about it constantly over the last week. But the reason last night was important, because you read the room. It's the start of what I view as a balancing act, and I think that's very important.
Well, we'll see if he starts to take those next steps then, Dan. Thanks so much. Appreciate it.
Thanks.
Well, we're wrapping up today's market domination.
And while we're wrapping up Domination, don't go anywhere. We got you covered with all the action following the closing bell. And a special thanks to, of course, Corey Johnson. Stay tuned for Market Domination.
Thank you.
Thanks, Corey.
Thank you, Corey.